In today's fast-paced world, you're just constantly bombarded with information, aren't you? Trying to sift through all those dense reports, press releases, investor presentations, figuring out what actually matters. It's a real challenge, and that's exactly where the deep dive comes in. We're basically your shortcut to getting truly well informed. We take those stacks of documents and turn them into, well, clear, compelling insights. Today, we're getting into the recent Q1 FY26 financial results from Jagsonpal Pharmaceuticals Ltd, and we've pulled everything straight from the source, their official filings, the latest press releases, their investor presentations. So, this is the real deal. Our mission here is pretty straightforward. Cut through the corporate jargon, yeah. Pull out the most important bits of knowledge and really understand what these numbers, these strategies, what they actually mean for Jagsonpal, for its market, and maybe even for your own broader understanding of the pharma sector. Okay, let's unpack this. So, kicking us off, let's just get straight to the headlines. What are those standout numbers? The ones that immediately tell us Jagsonpal Pharmaceuticals had a great Q1.
Right. Well, what's really fascinating here is just how strong their start to FY26 actually was. So for the quarter ended June 30, 2025, Jackson Powell put up some truly impressive numbers. Their revenue, it hit $756 million. Now, it's a really robust 23.1% year-on-year surge compared to the $614 million they had in Q1 of FY25. And, it's not just the year-on-year, it's also a big jump quarter-on-quarter, 29.1% growth from Q4 FY25. That was $586 million. Then there's operating EBITDA, earnings before interest, taxes, depreciation, and amortization. It's a key measure for operational profit. That reached $157 million. So that's a 24.1% increase year-on-year from $127 million. And get this, a huge 61.9% jump quarter-on-quarter from the $97 million in Q4. And here's the real kicker. Net profit, or P8, it soared to $108 million. Yeah, that's more than double the $53 million they reported back in Q1 FY25. And it also looks really good compared to the $66 million in Q4 FY25.
Wow, more than double the net profit. That's pretty remarkable. When you see a jump like that, is it usually just about selling more stuff? Or are there, deeper efficiency things going on? What did Jagsonpal's MD and CEO, Manish Gupta, actually say about these results?
Yeah, he was clearly pleased, and he did point towards those deeper factors. Manish Gupta commented directly on it, saying, "We have started FY26 on a strong note with growth across all parameters." And then he added, "The continued scale-up is an outcome of our disciplined and effective execution of our strategy." So, yeah, it sounds like it's not just volume. It's really about how they're running the business.
Okay, disciplined and effective execution. That sounds good. But what did they specifically do? How did they manage that impressive profit surge? Let's maybe peel back the layers a bit on their operational efficiency, dive into those margins.
Absolutely. That doubling of net profit, it really comes down to significant improvements in their margins. That's where you see that disciplined execution in action. So their gross margins improved by 80 basis points. It's 0.8%, bringing them to 64.4%. And they attribute this to strong brand equity and, again, that disciplined cost management. So basically getting more profit from every sale. The operating EBITDA margin also expanded. It was up 17 basis points year-on-year to 20.8%. But even more impressive, maybe, was the quarter-on-quarter jump of 420 basis points. That's quite a leap from 16.6% in Q4. And finally, the PAT margin, the bottom line, really, that expanded by 560 basis points to 14.3%. That's up from 8.7% a year ago. It just really highlights strong operational execution. They're turning more revenue into actual profit.
Right. And what about spending, the company's expenses during this quarter? Were there any big shifts there, or did they somehow manage to keep costs down even with all that growth?
Well, it's interesting. While profitability definitely soared, it doesn't look like they were, cutting back everywhere. We saw some expected increases, particularly in areas tied directly to their growth. For instance, cost of materials consumed went up to $53.32 million from about $35 million last year. Purchases of stock and trade also increased, $226.89 million compared to $175 million, which makes sense with higher sales. Employee benefits expense rose too, from about $156 million to $179 million, suggests investment in their people. And even things like share-based payments and other expenses saw increases. But I think the key takeaway here is that they achieved that strong profitability despite these necessary operational investments. That really speaks to their efficiency, doesn't it?
It really does. Okay, so beyond the profit and loss figures, let's look at the bigger picture of financial health. How strong is their cash position, and what does that tell us about their unique operational approach?
Yeah, their financial health looks exceptionally strong, very robust. Jacksonpal actually added $153 million of free cash just during this quarter, which brought its total cash balance up to a really solid euro 609 million as of June 30th. And as the company itself notes, this gives them, quote, ample room to invest in future growth.
Yeah.
And on the shareholder side of things, the board recommended a final dividend of 2.5 per share for the last fiscal year, FY25. That totals about 66 million, but it does still need shareholder approval at the AGM.
That is an incredibly strong cash balance, 1,600 million. But like you said, it's not just about having cash, right? It hints at a very specific strategy. How are they managing to generate cash like that consistently and stay so financially strong?
Exactly. You've hit on it. This robust cash generation, this financial strength, it's really underpinned by what Jagsonpal calls its asset-light model. It's sort of like being a conductor without actually owning all the instruments of the concert hall. They focus on the high-value stuff, the strategy, the marketing, building the brands, and they outsource the really capital-intensive activities. So things like R&D, they work with leading contract development and manufacturing organizations, CDMOs, and the actual manufacturing, that's handled by leading Indian contract manufacturing organizations, or CMOs. This model, it just frees up a huge amount of capital. It drives those strong cash flows we talked about. It allows for higher distributions to shareholders, and it really underpins what they call a zero debt and high ROCE business model, ROC being return on capital employed. It's fundamentally about efficiency and agility.
That's a really interesting way to operate in this sector. Were there any significant organizational changes or structural updates during the quarter? Anything that ties into this model, or just notable in general?
Yes, there were a couple of things worth mentioning. On the leadership side, their chief financial officer, Sachin Jain, actually left the company pretty recently on July 8th, 2025. It seems he was released during his probation period. They've said they're actively hiring a new CFO and expect to do so within their planned timelines. Then, in terms of employee incentives and share structure, Jagsonpal granted about 37,500 stock options, and they also allotted nearly 128,000 equity shares to eligible employees under their ESOP plan from 2022. And something else to note, though it happened last year, October 23, 2024, specifically they did a stock split. They subdivided their equity shares from a face value of 5 down to 2 each, which typically makes the stock seem more accessible maybe, and they restated the historical earnings per share figures accordingly, of course. Got it. Okay, let's broaden the view now. Beyond the internal stuff, what's Jagsonpal's strategy out in the market? How strong is their actual position in what is, let's face it, a pretty competitive pharmaceutical landscape? Yeah, it's definitely competitive, but Jagsonpal seems very strategically positioned. I mean, they're not new to this. They're a well-established company, over 4 decades of experience in the Indian market, listed on both the NSE and BSE. Their core business, as they define it, is manufacturing and trading pharmaceutical products. That includes APIs, active pharmaceutical ingredients. And they serve customers both in India and overseas. But interestingly, they treat all of this as a single reportable business segment. Keeps the focus tight, I suppose. What's really striking, though, is their strong portfolio in specific therapeutic areas. We're talking gynecology, orthopedics, dermatology, and childcare. They've really succeeded in building multiple market-leading brands in these spaces. Get this, over 20 of their brands rank in the top 5 within their specific molecule category. That includes 5 molecules where they rank number 1 and 14 brands in the top 5 overall. And their top 10 brands alone, they contribute 63% of total sales. That shows real concentration and strength in those core brands. Overall, according to a key industry metric, CMR RPM, they're ranked #8 in corporate CVM, that's corporate value market share. Gives you a good sense of their standing. And we dive just a bit deeper into those segment strengths using that same CMR RPM data. In gynecology, they're ranked number 7, and they reach something like 90% of all gynecologists across India. That's huge. They're a leader in progesterone therapies. Orthopedics, they're ranked number 2. Reaching about 80% of orthopedists, strong in osteoporosis and osteoarthritis treatments. Pediatrics, they're ranked 17th, connecting with roughly 27% of pediatricians. Key areas there are gut health, cough and cold, anti-itch. Dermatology, they're ranked 30th, reaching about 40% of dermatologists. Active in areas like demelanizing and antifungals. And supporting all this is a pretty extensive distribution network. Pan-India presence, over 1,000 experienced sales professionals, 18 stocking points across the country. They have the reach, and this isn't just a recent surge. Looking back, their long-term growth from FY21 to FY25 has been incredibly consistent. Their revenue CAGR compound annual growth rate over that period was 9.4%. Not bad.
But look at profitability. EBIT to CAGR was 27.8%, and PAT CAGR was even higher at 33.8%. Really strong bottom line growth. Both their EBITDA and PAT margins showed consistent improvement year after year during that time. And one more thing, their net working capital. They've managed that incredibly efficiently. It dropped from $249 million, which was over 13% of sales back in FY21, down to just $93 million, or 3.5% of sales in FY25. That means they're not tying up loads of cash in inventory or waiting for payments. It frees up capital again, testament to that asset-light efficiency.
That's a really comprehensive look at their market strength and consistency. Impressive. But, it's often not just about the financials, is it? What else stands out about Jackson Powell? What about their commitment beyond the bottom line? Did they have much of an impact, say, in the communities where they operate?
That's a great question to bring up. How does a company like this engage beyond just profits? And yeah, Jacksonpal seems to have a pretty significant corporate social responsibility effort. It's called the Maisaki Initiative. This initiative seems primarily focused on women's holistic well-being. They run it through their website, maisaki.in, which offers educational resources, health tools, community support features. A big part of Maisaki is driving awareness around menopause. They do this through virtual sessions, social media campaigns, community engagement, tackling a health topic that's often, frankly, overlooked. Their outreach also includes things like self-testing kits, offering discounted lab tests, and running an online forum to support women. And beyond that, Jagsonpal has also invested directly in improving hygiene access. They've built modern sanitation complexes, specifically for schoolgirls, in places like Punjab, Haryana, and Uttarakhand. That's about fostering health and dignity, right? So it seems like a genuine commitment to social impact.
That's really good to hear. Okay, so finally, let's turn our eyes to the future. What kind of guidance has management given? What's their strategic roadmap look like for, continued growth in this pretty dynamic pharma sector?
By connecting all the dots to look ahead. Jagsonpal seems to have a clear three-pronged growth strategy and a pretty positive outlook overall. The MD and CEO, Manish Gupta, he said he expects this strong growth momentum to continue. How? By deepening their presence in the domestic market. And he also specifically mentioned the, quote, prudent use of free cash to look for a strategically suitable inorganic opportunity, unquote. So acquisitions are definitely on the table. Their actual three-pronged strategy involves, first being niche innovation-driven. The goal here is to launch 4-6 new products every year, keep things fresh, drive engagement, drive revenue. Second prong, sales force empowerment. They plan targeted training to boost the knowledge and productivity of their medical reps. Makes sense. And third, focusing on their non-NLEM portfolio. NLEM is the National List of Essential Medicines, so these are products not on that list, meaning they have more pricing flexibility. The focus is on competitive pricing with quality, and on top of that organic strategy, like Gupta hinted, they're actively looking at inorganic moves.
That could mean acquiring specific brands within their current therapy areas or even broader business acquisitions to expand into new therapeutic areas altogether. So looking at their growth outlook specifically, Q1 FY26, we already saw that 23% plus revenue growth, 20% plus operating EBITDA improvement. For the full fiscal year 26, they're projecting 15% plus revenue growth, and importantly, a 100 to 150 basis points improvement in their operating margin, so becoming even more profitable. And looking even further out, beyond FY26, they anticipate steady, consistent revenue growth in the range of 12–14% per year. It's a confident outlook backed by a clear strategy.
Okay, so just to wrap up the core insights from this deep dive, we've seen how Jagsonpal Pharmaceuticals delivered a really strong Q1 FY26. It wasn't just about revenue growth, but also impressive profitability, operational efficiency. And this seems to be supported by that clever asset-light model, a clear strategic focus on their key therapy areas, market expansion, plus that notable commitment to social good with Maisaki.
Absolutely. And understanding these detailed reports, especially when you put them in the context of the company's strategy and its social efforts, it's just incredibly valuable for you, the listener. They don't just give you isolated numbers. They really paint a full picture of a company's health, where it's headed, its future trajectory. It's about getting that whole story, right? Not just the headlines.
Exactly. And as you think about all this, maybe here's a final thought for you to mull over. How does Jagsonpal's really unique asset-light model, especially combined with that strong cash position and their clear intention to grow through acquisition, how does that position them to adapt and really thrive in this constantly changing global pharmaceutical landscape? And maybe even broader than that, what implications could this kind of business model hold for other industries? Industries looking to balance that tightrope walk between capital efficiency, aggressive growth, and having a real, genuine social impact, something to think about.